Welcome to session 6, Basic Valuation Concepts. Valuation is the central theme in finance. In this session, we'll discuss the basic concepts of valuation. Finance deals with the trade-off between the present and the future. This is the distinctive feature of finance. When investors buy equity shares of a company, they make a sacrifice now, and the sacrifice is certain. They hope to derive benefits in future, and benefits are uncertain. Likewise, when a company invests in a new plant, it makes a sacrifice in the present, and the sacrifice tends to be certain. It hopes to derive benefits in future, and benefits tend to be uncertain. So in finance, we have to deal with time and risk. For pedagogic convenience, we'll first look at how we make adjustment for the time factor. Then we'll look at how the risk factor can be incorporated in financial decisions. What are the key differences between accounting and finance? Accounting deals with the past, accounting is concerned with certainty, accounting involves a review of what has happened, finance deals with future, finance is concerned with uncertainty, and finance is involved with decision making. Obviously, finance is more challenging and exciting because it deals with future and it involves uncertainty and it is focused on decision making. The three central pillars of finance are cash flow, time, and risk. All financial decisions are evaluated in terms of their impact on cash flow, the timing of the cash flow, and the riskiness of the cash flow. As someone observed very perceptively, revenue is vanity, profit is sanity, and cash is reality. The outline of the session is given here: time value of money, bond valuation, equity valuation, risk and return analysis, capital asset pricing model. A rupee today is more valuable than a rupee a year hence. Why? There are three important reasons. People prefer current consumption over future consumption. 2. Capital can be productively employed. 3. Inflation is a feature of most of the economies, which means a rupee a year from now would be less valuable than a rupee today. In order to discuss the time value of money, it is useful to set up a timeline. A timeline shows the cash flows, their time incidence, and the discount rates applicable to different periods of time. Here is a timeline where a cash flow of 10,000 occurs at the end of each year for 5 years, and the discount rate is 12% per year uniformly for 5 years. Here is a slightly modified timeline where there are 5 cash flows of 10,000 rupees each, but the first cash flow occurs at the beginning of year 1, the second cash flow occurs at the beginning of year 2, so on and so forth. The discount rate is 12% per year uniformly over the 5-year period. The notation that is commonly used for discussing time value of money problems is given here. PV is present value, FVN is future value n years hence, CT is cash flow occurring at the end of year T, A is a stream of constant periodic cash flow over a given time, R is the interest rate or discount rate, G is the expected growth rate in cash flows, N is the number of periods over which the cash flows occur. Future value of a single amount. To understand how the future value of a single amount is calculated, let us consider a simple example. Suppose you invest 1000 rupees at the beginning of first year and your investment earns a return of 10% per year and you allow the return to be retained in the investment account. At the end of the year, the principal amount will grow to 1100. 1000 is the initial investment, 100 is the interest for the year. Since interest is retained in the investment account, the principal at the end of year 1 will be 1100. At the beginning of year 2, the principal is 1100. The interest for the second year would be 10% thereof, so 110. So principal at the end of the second year will be 1210. At the beginning of the third year, the principal is 1210. Interest for the third year on this principal is 121. So the principal at the end of year 3 will be 1331. In general, the future value is equal to present value multiplied by 1 plus r raised to the power n, where r is the interest rate applicable to the investment and n is the period for which compounding is done. The future value factor depends on r and n. Other things being equal, higher the r, higher the future value factor, and larger the n, higher the future value factor. Here is a table which shows the future value factor for various combinations of R and N. If R is 6% and N is 4, then the future value factor is 1.262. If R is 10% and N is 8, future value factor is 2.144. If R is 14% and N is 10, future value factor is 3.707. Investors commonly ask, how long will it take to double an investment? There is a popular rule of thumb called the rule of 72 which answers this question. According to the rule of 72, the doubling period is equal to 72 divided by interest rate. If the interest rate is 15%, the doubling period is 72 divided by 15, which is 4.8 years. A more accurate thumb rule is rule of 69. According to the rule of 69, the doubling period is equal to 0.35 plus 69 divided by interest rate. If the interest rate is 15%, the doubling period is 0.35 plus 69 divided by 15, which works out to 4.95 years. So far we looked at annual compounding. What happens if compounding happens more than once in a year? What happens if compounding is done every 6 months or every 3 months or every month? In such a case, future value is equal to present value multiplied by 1 plus r divided by m, the whole raised to the power of m into n, where r is nominal annual interest rate, m is number of times compounding is done in a year, n is number of years over which compounding is done. Here is an example. Rupees 5,000 is invested at a nominal annual interest rate of 12%, but compounding is done 4 times a year. What would be the value of this investment 6 years hence? The value of this investment 6 years hence would be 5,000 multiplied by 1 plus 0.12 divided by 4, the whole raised to the power of 24, which is 5,000 multiplied by 1.03 raised to the power 24. This works out to rupees 10,164. When compounding is done more than once in a year, a distinction is made between the effective rate of interest and the nominal rate of interest. The relationship between the effective rate of interest, the nominal rate of interest, and the frequency of compounding per year is shown in this formula, where R is the effective rate of interest, K is the nominal rate of interest, M is the frequency of compounding per year. Here is an example. K, or the nominal rate of interest, is 8%, M is 4, effective rate of interest is 1 plus 0.08 divided by 4 raised to the power 4 minus 1. It is 0.0824 or 8.24%. Here is a small table showing the relationship between the nominal rate of interest and the effective rate of interest for different periods of compounding. If compounding is done annually, the nominal rate of interest and the effective rate of interest are the same. If compounding is done semi-annually, the effective rate of interest is 12.36%. If compounding is done quarterly, the effective rate of interest is 12.55%. When compounding is done monthly, the effective rate of interest is 12.68. When we look at this line, we find that as the frequency of compounding increases, the effective rate of interest increases. However, marginal increases tend to decline. So, the effective rate of interest approaches a certain limit. In this case, the effective rate of interest is 12.75% or so. Some people are under the impression that as the frequency of compounding increases, the effective rate of interest will rise dramatically. That doesn't happen because it approaches a limit. Future value of an annuity. An annuity represents a constant periodic cash flow. The payment of insurance premium over a number of years is an example of annuity. Likewise, if you deposit 150,000 rupees in your public provident fund account for 15 years, it is an example of an annuity. How do we calculate the future value of an annuity? To understand the calculation of future value of an annuity, we'll work with a simple example. Suppose you invest 1000 rupees for 5 years in an investment account. The first investment occurs at the end of year 1, the second investment occurs at the end of year 2, so on and so forth. Your investment earns a return of 10%. This is a case of a regular annuity. In a regular annuity, the first payment occurs at the end of year 1, the second payment occurs at the end of year 2, so on and so forth. What will be the future value of this annuity at the end of year 5? Let us look at individual deposits that you make in the investment account and how they grow over a period of time. The first deposit of 1000 at the end of year 1 will compound for 4 years. Remember, we are evaluating the future value of this annuity at the end of year 5. So this will compound for 4 years. The compounded value would be 1000 multiplied by 1.10 raised to the power 4. It works out to 1464. The second deposit will compound for 3 years, so it will be 1000 multiplied by 1.10 raised to the power 3, it is 1331. The third deposit compounds for 2 years, so it is 1000 multiplied by 1.1 raised to the power 2, it is 1210. The fourth deposit compounds for 1 year, so it is 1000 multiplied by 1.1. The fifth deposit doesn't compound because we are looking at the value of the annuity as at the end of year 5. If we add all these numbers, we find that future value of this annuity is 6105. What is the general formula for future value of annuity? The general formula is 1 plus r raised to the power n minus 1 the whole divided by r, where r is the interest rate, n is the period of the annuity. In this case, we are talking of r as 10%, n as 5 years. So 1 plus r raised to the power n minus 1 the whole divided by r is 6.105. It means an annuity of 1 rupee will have a future value of 6.105. We are talking of an annuity of 1000 rupees, so it is 6105. That is where A comes in. The future value annuity factor for various combinations of R and N is shown here. When N is 10 years and R is 10%, future value of annuity factor is 15.937. When N is 30 and R is 15%, future value annuity factor is 437.745. Let us look at a table like this to get an idea of the power of compounding. If we invest 10,000 rupees at the end of every year for 10 years and your investment earns a return of 8%, then your investment grows in value to 144,870. If you invest 10,000 rupees for 40 years and you are able to generate a return of 18% over a 40-year period, then your investment stream will accumulate in value to 41,632,000. That is the power of compounding. That is why compounding is referred to as the most powerful phenomenon known to mankind. You may be wondering why your ancestors were not so far-sighted. I hope you will show concern for the posterity. We can apply our knowledge of future value annuity factor to address a variety of issues. What lies in store for you? Suppose you have decided to deposit rupees 100,000 per year in your public provident fund account for 30 years. How much will it accumulate to after 30 years if the interest rate is 7%? the cumulative sum will be 100,000 multiplied by future value annuity factor 7% 30 years. The future value annuity factor is given here. This works out to 94.96. So an annual deposit of 100,000 rupees made at the end of each year for 30 years will accumulate in value to 9,460,000. How much should you save annually? You want to buy a house after 5 years when the down payment is expected to cost rupees 2 million. How much should you save annually if your savings earn a compound return of 12%? The future value annuity factor for a 5-year annuity given an interest rate of 12% is FVA n equal to 5, R equal to 12%. This works out to 6.353. The annual savings should be 2 million divided by 6.353. It is rupees 314,812. Finding the interest rate. A finance company advertises that it will pay a lump sum of rupees 8,000 at the end of 6 years to investors who deposit annually rupees 1,000 for 6 years. What interest rate is implicit in this offer? The interest rate may be calculated in 2 steps. 1. Find the future value annuity factor for this contract. Rupees 8,000 is equal to rupees 1,000 multiplied by future value annuity factor. So future value annuity factor works out to 8,000 divided by 1,000. To look at the future value annuity factor table and read the row corresponding to 6 years until you find a value close to 8. Doing so, we find that future value annuity factor for 12% in 6 years is 8.115. So we conclude that the interest rate is slightly below 12%. How long should you wait? You want to take a trip to the moon which costs rupees 1 million. The cost is expected to remain unchanged in nominal terms. You can save annually rupees 50,000 to fulfill your desire. How long will you have to wait if your savings earn a return of 12%? The future value of an annuity of rupees 50,000 that earns 12% is equated to rupees 1 million, the cost of the trip to the moon. So 50,000 multiplied by the future value annuity factor is 1 million. In this future value annuity factor, R is known as 12%, N is unknown. So we set up an equation like this: 50,000 multiplied by 1.12 raised to the power n minus 1 divided by 0.12 is equal to 1 million. Hence 1.12 raised to the power n minus 1 is 1 million divided by 50,000 into 0.12, which is 2.4. So 1.12 raised to the power n is equal to 3.4. Take the log of both the sides. N log 1.12 is log 3.4. N multiplied by 0.0492 is equal to 0.5315. So N works out to 10.8 years. This means you'll have to wait for 11 years to fulfill your dream to take a trip to the moon. Just the way we have future value annuity factor, we have present value annuity factor. The present value annuity factor is simply future value annuity factor divided by 1 plus r raised to the power n. If we simplify that equation, it reduces itself to 1 minus 1 by 1 plus r raised to the power n the whole divided by r. Here are some illustrative values of present value annuity factor. If n is 6 years and r is 10%, present value annuity factor is 4.355. If n is 12 years and r is 14%, present value annuity factor is 5.66, which means if you get 1 rupee at the end of each year for 12 years and the discount rate is 14%, the present value of that stream of benefits is 5.66. Loan amortization schedule. Suppose a firm has taken a loan of 1 million at an interest rate of 15% and the loan is repayable in 5 equal annual installments. The first installment will be paid at the end of year 1. To figure out the annual installment, we set up an equation like this. 1 million is equal to A multiplied by present value annuity factor, where N is 5 years and R is 15%. The present value annuity factor is 3.3522. So A in this equation works out to 298,312. It means a loan of 1 million can be repaid in 5 equal annual installments if the annual installment is 298,312. What is going on here? To understand what is going on here, we can set up a table like this which shows the loan amortization schedule. At the beginning of year 1, the outstanding loan amount is 1 million. On this 1 million, the interest for year 1 would be 150,000. The annual installment of 298,312 would be paid at the end of year 1. Out of this, the interest amount is deducted, and hence the principal repayment would be 148,312. After this principal repayment, the outstanding amount on principal account will be 851,688, which is the beginning amount for year 2. On this, the interest is 15%, which is 127,753. Annual installment is 298,312. So the principal repayment would be the difference between the two, which is 170,559. So the principal amount at the end of year 2 would be 681,129, so on and so forth. At the end of year 5, this amount should whittle down to 0, but there is a rounding off error here. Equated monthly installment. Suppose you have taken a housing loan of 1 million at an interest rate of 1% per month, and the loan is repayable in 180 equal monthly installments. What is the equal monthly installment? The equal monthly installment can be calculated using this formula. 1 million is equal to A, the monthly installment, multiplied by 1 minus 1 by 1 plus R raised to the power of 180, the whole divided by R, which is 0.01 or 1%. A in this case works out to 12,002, which means a loan of 1 million can be repaid over a period of 180 months if the interest rate is 1% by paying a monthly amount of 12,002. Present value of a perpetuity. While an annuity has a finite life, a perpetuity has an infinite life. If you get an annual income of 100,000 per year forever, you have a perpetuity. The present value of a perpetuity is A, the annual cash flow, divided by R, the interest rate. Here is an example. Suppose you get an annual income of 100,000 per year forever, and the interest rate is 10%. In this case, the present value of perpetuity is A divided by R, which works out to 1 million. You can see how an amount of 1 million can generate an annual income of 100,000 if the interest rate is 10% without any impairment of principal. At the end of each year, 1 million would provide an income of 100,000 and the principal will remain unimpaired. So the principal has the capacity to generate this income year on year forever. Let us review the key formulae for time adjustment. Future value factor corresponding to R and N is equal to 1 plus R raised to the power N. Present value factor corresponding to R and N is equal to 1 divided by 1 plus R raised to the power N. Future value annuity factor corresponding to R and N is 1 plus R raised to the power N minus 1 divided by R. Present value annuity factor corresponding to R and N is 1 minus 1 divided by 1 plus r raised to the power n divided by r. Present value of a perpetuity is 1 divided by r. I found these formulae extremely helpful in my professional and personal work. You will also find them very useful in your financial analysis. If you are not inclined to do the calculation by hand, you can use Excel spreadsheet. Excel is perhaps the best financial calculator ever invented. In Excel, there are customized notations and functions for various time value parameters. You can calculate the present value, the future value, the number of continuous periods, payment per period, and interest rate given the values of other variables. Excel has a set of functions for performing financial calculations. These are NPER, rate, PV, FV, NPMT. NPER stands for the number of periods. Rate stands for interest rate. PV stands for present value. PMT stands for annuity payment. And FV stands for future value. All of these functions are based on the timeline of an annuity as shown below, 0, 1, 2, so on and so forth, number of periods, present value, annuity payment, and future value. Along with interest rate R, there are 5 variables: NPR, rate, PV, PMT, and FV. Each function takes 4 of these variables as inputs and generates the value of the 5th variable to ensure that the NPV of the cash flows is 0. This means the function will solve the problem NPV is equal to 0 is equal to present value plus annuity payment multiplied by 1 by rate whole multiplied by 1 minus 1 by 1 plus rate raised to the power of NPER plus future value divided by 1 plus rate whole raised to the power of NPER is equal to 0. Put in words, the initial amount PV plus present value of the annuity payments PMT plus the present value of the final payment FV has a net present value NPV of 0. Basic valuation model: the value of any asset, real or financial, is equal to the present value of the cash flows expected from it. VO, the value of an asset at time 0, is equal to present value of cash flows expected from it. Let us assume that cash flows expected from it are C1 at the end of year 1, C2 at the end of year 2, so on and so forth, and finally Cn at the end of year n. The life of the asset is n years, so the value of the asset is given by this equation where VO is value of the asset at time 0, CT is cash flow expected at the end of year t, R is discount rate applicable to the cash flows, n is the life of the asset. This is a general formula. It can be applied to value any asset, real or financial. As the legendary investor Warren Buffett put it, the value of any stock, bond, or business today is determined by the cash inflows or outflows, discounted at an appropriate discount rate that can be expected to occur during the remaining life of an asset. Here is a simple example. An asset is expected to produce cash flows of 20, 30, and 220 at the end of year 1, year 2, and year 3. The discount rate applicable to the cash flows is 16%. So the value of the asset is 20 discounted for 1 year plus 30 discounted for 2 years and 220 discounted for 3 years. The discount factors are 0.862, 0.763,
and 0.641. Applying these factors to respective cash flows, we find the value of the asset to be 180.55. Thus, the key inputs in valuation are cash flows, timing, and discount rate. Basic bond valuation model. Basic bond valuation model is expressed in this equation where V is the value of the bond, I is the annual interest receivable at the end of each year, N is the residual life of the bond, F is the face value or par value of the bond receivable at the end of N years, R is the discount rate applied by investors. If we look at this equation, we find that it is equal to I multiplied by present value annuity factor Rn plus F multiplied by present value factor Rn. Here is an example. A bond has a face value or par value of rupees 100. It carries an interest rate of 12%. It has a residual maturity of 8 years. The required return by investors is 14%. When we plug in these numbers, we find that the value of the bond is rupees 12 multiplied by present value annuity factor 14%, 8 years, plus rupees 100 multiplied by present value factor 14%, 8 years. PVA 14% 8 years is 4.639. PV 14% 8 years is 0.351. So the value of the bond works out to rupees 90.77. How is the yield on a bond calculated? A very simple measure of yield is current yield. A more accurate measure is yield to maturity. The current yield on a bond is annual interest divided by price. If a bond provides an annual interest of 90 rupees and its current market price is 800 rupees, the current yield is 90 divided by 800, which is 11.25%. Yield to maturity. To calculate the yield to maturity, we have to set up an equation like this. In this equation, P is the current market price, C is the annual interest received from the ownership of the bond, N is the residual life of the bond, and M is the maturity value receivable from the ownership of the bond. In this equation, C and M and N are known. Likewise, P is known. We have to solve this equation for R. Let us look at a numerical example. The maturity value of a bond is 1000 rupees. The bond carries an interest rate of 9%. The bond has a residual life of 8 years. The current market price of the bond is 800 rupees. So we set up an equation like this. P, the current market price, is 800. 90 rupees is the interest benefit receivable from the owners of the bond every year for 8 years. 1000 is the principal amount receivable at the time of maturity 8 years hence. We have to find the value of R, which makes the right hand side of this equation equal to 800. There is no analytical formula for determining the value of R. We have to try different values of R till we find a value of R which makes the right hand side equal to 800. Let us try a value of R of 13%. If we use 13% in this equation, the right hand side is 808. So we try a higher value of R. Let us try 14%. When we try 14%, the right hand side becomes 768, which means the yield to maturity lies between 13% and 14%. In this range of 1%, we resort to linear interpolation, which is considered fairly satisfactory for practical purposes. So the yield to maturity is 13% plus 808 minus 800 divided by 808 minus 768, because at 14% the right hand side becomes 768. At 13% the right hand side becomes 808. So our target is to reach 800. So we look at the difference between 808 and 800, which is 8, and the difference between 808 and 768, which is 40. So this is 0.2 multiplied by the difference between 14% and 13%, so it becomes 0.2%, and the yield to maturity works out to 13.2%. If you are not inclined to go through a trial and error procedure, you can use a formula which gives you a fairly good approximate value. The formula is YTM, or yield to maturity, is approximately equal to C plus M minus P divided by N, the whole divided by 0.4 times M plus 0.6 times P, where C is the annual interest receivable from the ownership of the bond, M is the maturity value, P is the current market price, N is the residual maturity period, and M and P, as we have seen, are maturity value and current market price. We find that YTM calculated using this formula is 13.1%, which is fairly close to the correct YTM. I found this formula very useful. It's a shortcut which gives an approximation which is fairly reliable. So far we looked at bonds which paid interest annually. Most bonds, however, pay interest semi-annually. When bonds pay interest every 6 months, the semi-annual interest would be C divided by 2. The number of periods would increase from n to 2n, and the periodic discount rate will reduce from R to R by 2. When we make these substitutions, the price of the bond is calculated in this manner. Price is equal to summation T equal to 1 to 2n, because we are talking about 2n periods. Periodic interest is C by 2 and the discount rate is R by 2. This is summated over 2n periods. M is the maturity value. It is discounted at R by 2 over a period of 2n, which means value is equal to C by 2 multiplied by present value annuity factor R by 2 2n plus maturity value multiplied by present value factor R by 2 2n. As an illustration, consider an 8-year 12% coupon bond with a par value of ₹100 on which interest is paid semi-annually. The required return on this bond is 14%. So 8 years will mean 16 half-yearly periods. 12% coupon on an annual basis will mean 6% coupon on a half-yearly basis, and a required return of 14% on an annual basis will mean 7% on a semi-annual basis. Making these substitutions, we find that the value of the bond is given here, which means 6 multiplied by present value annuity factor 7% 16 years plus 100 multiplied by present value factor 7% 16 years. These factors are 9.447 and 0.339. So the value of the bond works out to rupees 90.6. The Excel function for the price of the bond is given here. Settlement date 11/2015, maturity date 30/12/2022. We have assumed that the bond has a residual maturity of 8 years. The annual coupon rate is 12%. The required yield per annum is 14%. Redemption price is 100 rupees. Frequency is 2. This means the number of times interest is paid in a year is 2. Price is 90.55. To get the result in B8, use the function given here. This is the Excel function. It is clear that other things being equal, higher the yield, lower the price, and lower the yield, higher the price. The relationship between price and yield is shown in this graph. The 5 important bond price theorems are: 1. Bond prices and yields move in opposite directions. 2. bond prices are more sensitive to yield changes the longer their maturities. 3. The price sensitivity of bonds to yield changes increases at a decreasing rate with maturity. 4. High coupon bond prices are less sensitive to yield changes than low coupon bond prices. 5. With a change in yield of a given number of basis points, the associated percent gain is larger than the percent loss. The duration of a bond is the weighted average of the times to each of the cash payments. The times are the future years 1, 2, 3 till t, where t is the maturity date. The weight for each year is the present value of the cash flow received at the time divided by the total present value of the bond. So these time periods 1, 2 to t are weighted by present value of the cash flow received divided by the total present value of the bond. So weights are PVC1 divided by PVC2 divided by PV, so on and so forth. Here is a numerical illustration. The face value of a bond is rupees 100, interest rate is 15% payable annually, yield to maturity is 6 years, redemption value is rupees 100, current market price is 89.50, yield to maturity is 18%. The calculation of duration is shown in this table. The cash flows for years 1 through 6 are shown in this column. The present value of these cash flows at 18% discount rate are shown in this column. The sum obviously adds to rupees 89.50. 12.71 as a proportion of 89.5 is 0.142. 10.77 as a proportion of 89.5 is 0.120, so on and so forth. These proportions are multiplied by the time. This is multiplied by 1, this is multiplied by 2, this is multiplied by 3, so on and so forth. So the products are noted in this column. When we add all the numbers in this column, we get 4.257 years, which is the duration of this bond. Valuation of a preference stock. A preference stock is similar to a bond because a preference stock carries a fixed rate of dividend and is redeemable after a certain number of years. So the value function of a preference stock is similar to the value function for a bond. Since the stream of dividends is an ordinary annuity, we can apply the formula for the present value of an ordinary annuity. Hence, the value of the preference stock is PO is equal to D, which is the annual dividend receivable from preference stock, multiplied by present value annuity factor RPN plus M, maturity value, multiplied by present value factor RPN, where RP is the required rate of return on the preference stock and N is the life of the preference stock. To illustrate how to compute the value of a preference stock, consider an 8-year 10% preference stock with a par value of rupees 1000. The required return on this preference stock is 9%. Given a par value of 1000, a dividend rate of 10% and a required return of 9%, the value of the preference stock is 100 multiplied by present value annuity factor 9%, 8 years, plus 1000 multiplied by present value factor 9%, 8 years. PVA 9% 8 years is 5.535, PV 9% 8 years is 0.502. So the value of the preference stock is 1110.5. Here the dividend rate on the preference stock is higher than the required rate, so the preference stock sells at a premium. If the dividend rate and the required rate were the same, the value of the stock will be equal to its par value. Finally, if the dividend rate is less than the required rate, the preference stock could sell at below par. Equity valuation. While bond valuation is a relatively straightforward exercise, equity valuation is challenging, interesting, imprecise, frustrating, and exhilarating. There are several approaches to equity valuation. The most important approach is the dividend discount approach. There are several variants of the dividend discount model. The simplest of them is the single period valuation model. According to this model, the value of a share is equal to dividend from the share receivable a year from now plus the price that will be realized from the sale of the share. Here it is assumed that the investor will own the share for a year, so he is looking for a dividend after a year and a share price that he will realize when he sells the share a year from now. These two benefits are discounted at a discount rate which is appropriate to the riskiness of the stock. Multi-period valuation model assumes that the investor will remain invested indefinitely, so the value of the stock is equal to the present value of the stream of dividends receivable from the ownership of the stock from here to eternity. D1 is the dividend receivable a year from now, D2 is the dividend receivable for 2 years from now, so on and so forth. A simple variant of the multi-period dividend discount model is the zero growth model. In this model, it is assumed that the dividend per share remains constant year after year forever. There is no growth whatsoever in the dividend stream. According to this model, the value of a share is equal to present value of future dividends receivable from the ownership of those shares. Since these dividends remain constant, the equation looks like this. If we look at this equation, it simplifies itself beautifully to PO equal to D by R. We have already encountered an equation like this when we are looking at present value of a perpetuity. This is also a perpetuity. Suppose a share provides a constant dividend of 10 rupees per year forever and investors require a return of 12% from the ownership of the share. The value of such a share would be 10 divided by 0.12, which is 83.33. When investors pay 83.33, they get a return of 12% every year forever. Constant growth dividend discount model. This is the most popular version of the dividend discount model. In this model, we assume that dividend per share grows at a constant rate of G% per year forever. We have learned that well-managed companies plow back 30, 40, 50, 60, 80% of their earnings. Plowed back earnings augment net worth, which in turn enhances future earnings and future dividend capacity. So dividend per share of such companies tends to grow over a period of time. So it's a fairly reasonable assumption for well-managed companies. This expression shows the present value of the stream of future dividends receivable from here to eternity. Here, dividend per share grows at a constant rate. The expression may look menacing and daunting, but it simplifies itself to an elegant equation. PO is equal to D1 divided by R minus G. This is one of the most useful formulae in finance. Let us apply this formula for some numbers. Dividend per share is 10 rupees. R, the required rate of return is 12%. The constant growth rate applicable to dividend per share is 8%. PO would be 10 rupees divided by R, which is 0.12 minus G, which is 0.08. So value per share works out to rupees 250. Let us increase the dividend growth rate from 8% to 9%. When we plug in a value of 9% in this equation, the value of the share works out to rupees 333. If we try a value of 10% for the growth rate, then the value per share is 10 divided by 0.12 minus 0.10, which is rupees 500. So we find that the price per share or value per share is highly sensitive to small changes in the growth rate. This is perhaps the reason why the stock market fluctuates so wildly. Investors form divergent expectations about growth rate at different points of time, and these expectations are embedded in the prevailing market prices, which tend to fluctuate a great deal. A very popular approach to earnings valuation is earnings multiplier approach. Under this approach, a multiplier is applied to earnings per share for the following year to get the value of the share. What are the determinants of this multiplier, which is also referred to as the price earnings multiplier? To understand the determinants of the P multiplier, let us start with the constant growth dividend discount model, which we learned earlier. PO is equal to D1 divided by R minus G, where D1 is the dividend expected a year from now, R is the rate of return required by equity shareholders, and G is the constant growth rate applicable to dividends. Let us look at what the dividend a year from now would be. A dividend a year from now would be earnings per share a year from now multiplied by the dividend payout ratio, and dividend payout ratio is defined as 1 minus B, and B is the retention ratio. So if the dividend payout ratio is 0.3, retention ratio will be 0.7. So in the numerator of this ratio, we have dividend per share for year 1, which is earnings per share for year 1, multiplied by the payout ratio, which is defined as 1 minus B. In the denominator, we have R minus G. What is a growth rate that can be sustained forever? A growth rate that can be sustained is the product of return on equity and retention ratio. So ROE multiplied by retention ratio. This is a formula for estimating the intrinsic value of a share. Now, let us divide both sides of this formula by E1. On the left hand side, we have PO divided by E1. On the right hand side, when we divide the equation by E1, the numerator becomes 1 minus B. The denominator, of course, remains unchanged. This is the formula for the price earnings multiple. Let us consider a numerical example. The payout ratio of a firm, or 1 by B, is 0.3, which means 30% of earnings are paid out. So the retention ratio would be 70% or 0.7. Return on equity of this firm is 16%. So I have a value of 0.16 here. The rate of return required by shareholders of this firm is 13% or 0.13. When I use these numbers, I find that the price earnings multiplier for this company works out to 16.67. It is like saying that a firm which pays out 30% of its earnings as dividend, which earns a return on equity of 16%, and whose shareholders require a return of 13%, will command a price earnings multiple of 16.67. Here are the important points to be remembered in the context of valuation of assets, real or financial. The value of any asset, real or financial, is equal to the present value of the cash flows expected from it. The value of a bond is V equal to summation interest over a period of n years discounted to the present point of time plus the face value discounted for n years. The yield to maturity on a bond is the rate of return the investor earns when he buys the bonds and holds it till maturity. It is the value of R in the bond valuation model. For estimating the YTM readily, the following approximation is very useful. YTM is approximately equal to I plus F minus P divided by N, the whole divided by 0.4 F plus 0.6 P. According to the dividend capitalization model, the value of an equity share is equal to the present value of dividends expected from its ownership plus the present value of the resale price expected when the equity share is sold. Most equity valuation models are based on the assumption that dividends tend to increase over time. If dividends are expected to grow at a constant rate, the following equity valuation model, a very popular model, is used. PO is equal to D1 divided by R minus G. In our discussion so far, we have assumed a given discount rate. We have by and large glossed over risk and the relationship between risk and return. Now we'll examine the relationship between risk and return more explicitly. Our discussion of risk and return analysis is divided into four parts: risk and return of a single asset, risk and return of a portfolio, measurement of market risk, relationship between risk and return. All these are very important facets of finance. Let us look at the risk and return of a single asset. The rate of return on a single asset is equal to annual income derived from the asset divided by beginning price plus ending price minus beginning price divided by beginning price. This represents the current yield. This represents the capital gains yield. The rate of return on equity stocks, like the rate of return on many other assets, is highly variable. So we have to work with the probability distribution and expected rate of return. Here is a numerical example showing how we calculate the expected rate of return. We look at two stocks, Bharat Foods and Oriental Shipping. The rate of return on Bharat Foods can vary between 16% and 6% depending on the state of the economy. If the economy is in a state of boom, Bharat Foods would earn a return of 16%. If the economy is in a normal state, Bharat Foods would return 11%. If the economy is in recession, Bharat Foods would deliver a return of 6%. The rate of return on Oriental Shipping Company is also a function of the state economy. If the economy is in a state of boom, Oriental Shipping would deliver a return of 40%. If the economy is in a normal state, Oriental Shipping would deliver a return of 10%. If the economy is in a state of recession, Oriental Shipping Company would deliver a negative return of 20%. These are the probabilities associated with these three states of economy. The expected return is simply probability multiplied by rate of return summated over all possible occurrences. The expected return on Bharat Food stock is 0.3 times 16% plus 0.5 times 11% plus 0.2 times 6%. It works out to 11.5%. Similarly, the expected return on Oriental Shipping stock works out to 0.3 multiplied by 40% plus 0.5 multiplied by 10% plus 0.2 multiplied by minus 20%. So it is 13%. When we look at the rate of return profile of these two stocks, we find that Bharat Foods has lesser variability in its rate of return compared to Oriental Shipping. Bharat Foods represents a defensive stock. Oriental Shipping represents a more volatile stock. The expected return on Bharat Foods is 11.5%, whereas expected return on Oriental Shipping is 13%. Standard deviation and variance are the two most popular measures of risk in finance. Let us understand how standard deviation and variance are calculated with the help of an example. We look at the data of Bharat Food stock and Oriental Shipping stock given in the previous slide. Here is the probability distribution of the rate of return on Bharat Food stock. The product of probability and rate of return is shown in this column. So when you add these numbers, you get the expected return on Bharat Food stocks. Now we look at the deviation of actual return from expected return in this column. 16% minus 11.5% is 4.5%. 11% minus 11.5% is minus 0.5%. 6% minus 11.5% is minus 5.5%. In the next column, we look at the squared values of the numbers in the previous column. 4.5 squared is 20.25, minus 0.5 squared is 0.25, minus 5.5 squared is 30.25. In the last column, we multiply these values with corresponding probabilities. Zero point 0.3 multiplied by 20.25 gives 6.075. 0.5 multiplied by 0.25 gives 0.125. 0.2 multiplied by 30.25 gives 6.05. We add all these numbers. The sum of these numbers is 12.25. This is variance. The square root of variance is standard deviation. Here I have variance. I have taken variance and found out the square root of variance, which is 3.5%. In the case of oriental shipping stock, we find that the variance is 441 and the square root of variance is 21%, which is 441 raised to the power of 1 by 2. So we find that the standard deviation of return on oriental shipping stock is much higher than the standard deviation return on Bharat food stocks. This is understandable. Shipping stocks are more volatile than food stocks. Since investors generally invest in a portfolio of securities, we should know how to calculate the expected return and risk of a portfolio. The expected return of a portfolio is given by this formula. This is expected return of a portfolio. This is weight assigned to security I in the portfolio. This is expected return of security I. This product is summated over the number of securities in the portfolio. Let us look at the portfolio of two stocks, the stocks of Bharat Food and Oriental Shipping. Expected return on Bharat Food stocks is 11.5%. Expected return on the stock of Oriental Shipping is 13%. If we assume that the weights assigned to these two stocks are 0.6 and 0.4, we find that the expected return of a portfolio consisting of Bharat Foods and Oriental stocks in these proportions is 12.1%. What is the effect of diversification portfolio risk? To understand the effect of diversification portfolio risk, let us look at a numerical example. There are 5 possible states of the economy, 1 through 5. All these states are equally probable. The return on stock A under these 5 states of economy is shown here. The return on stock B under these 5 states of economy is shown here. These stocks are different from the ones that we considered earlier. The return on a portfolio consisting of A and B in equal proportions is shown in this column. This is simply the arithmetic average of these two numbers, so on and so forth. The expected return on stock A is 0.2 times 15% plus 0.2 times minus 5%, so on and so forth. So the expected return on stock A is 15%. The expected return on stock B is 0.2 times minus 5% plus 0.2 times 15%, so on and so forth. It is 15%. The expected return on a portfolio of A and B is 0.2 times 5% plus 0.2 times 5%, so on and so forth. It is also 15%. The standard deviation of return on stock A is calculated here. We first calculate the variance of return on stock A. Variance is 0.2 times the deviation squared. Deviation would be return on the stock less expected return, return on the stock less expected return, it is squared. Similarly, we have other deviations squared and multiplied by their respective probabilities. So variance is 200, standard deviation is square root of variance, which is 14.14%. we have a similar calculation for stock B and a similar calculation for a portfolio consisting of A and B in equal proportions. When we look at these numbers, we find that the standard deviation of return on stocks A and B individually is 14.14%, but the standard deviation of the portfolio return is only 9.49%. This happens because the returns on the two stocks do not move in a perfect lockstep. They move in different directions or they move in an uncorrelated manner. So there is a benefit of diversification. In general, when stocks do not move in perfect tandem, there is a benefit of diversification. How is the risk of a portfolio consisting of two securities defined? The risk of a portfolio consisting of two securities is expressed in this manner. Sigma P is the standard deviation of the portfolio return. W1 is the weight assigned to security 1. Sigma 1 is the standard deviation of the return on security 1. W2 is the weight assigned to security 2. Sigma 2 is the standard deviation of the return on security 2. Rho 1, 2 is the degree of correlation between the returns on securities 1 and 2. Sigma 1 is the standard deviation of the return on security 1. Sigma 2 is the standard deviation of the return on security 2. In this equation, we have a new term called rho 1, 2 or coefficient of correlation between the returns on 1 and 2. Coefficient of correlation measures the degree to which the two returns move together. Coefficient of correlation can vary between -1 and +1. A coefficient of correlation of -1 means that the two securities move exactly in opposite directions. A coefficient of correlation of +1 means that two securities move in perfect lockstep. If a coefficient of correlation is 0, it means that the two securities have uncorrelated returns. In real life, we find that coefficient of correlation is usually 0.3, 0.4, 0.5 or something of that kind. You rarely find a coefficient of correlation which is -1 or +1. Here is a numerical example. The weights assigned to the two securities W1 and W2 are 0.6 and 0.4. The standard deviations of returns on securities 1 and 2 are 0.1 and 0.16, that is 10% and 16%. Coefficient of correlation is 0.5. If I plug in these values in the equation discussed just now, I find that the standard deviation of the portfolio return is 10.7%. Harry Markowitz developed modern portfolio theory. For this seminal contribution, he received Nobel Prize in Economics. After he got the Nobel Prize, I had a wonderful opportunity of interviewing him. I asked him what prompted him to work on this topic. He said as a doctoral student, he was sitting outside the office of his dissertation advisor in University of Chicago. There was another visitor who was a stockbroker. During a conversation with the stockbroker, he learned that investors have great difficulty in comprehending risk and the relationship between risk and return. That conversation prompted him or persuaded him to work on this idea. So we must be grateful to that casual conversation between a stockbroker and a doctoral student for modern portfolio theory, which is a foundational theory of modern finance. What is the relationship between diversification and risk? In a previous example, we learned that two securities individually had a standard deviation of return of 15%, but when they were combined in a portfolio, the portfolio return standard deviation was less than 9.5%. diversification reduces portfolio risk. Does it mean that if you have a very widely diversified portfolio, you can completely eliminate portfolio risk? It does not happen because there are two sources of risk: unique risk and market risk. Unique risk can be diversified away, but market risk cannot be diversified away. Let us understand this distinction. Unique risk is risk that stems from company specific factors. There may be a favorable development in one company and an unfavorable development in another company. For example, Hindustan Unilever may introduce a product very successfully, whereas Tata Motors may be facing challenges in the domestic market. Aurobindo Pharma may be facing challenges with FDA, whereas Dr. Reddy's Laboratories may introduce a new product very successfully in the European market. When you add more and more securities to the portfolio, some favorable developments in some companies are likely to be offset by some unfavorable developments in other companies. So, unique risks can be diversified away because they are risk emanating from company specific factors. Market risk stems from economy-wide factors such as GDP growth rate, exchange rate, interest rate, and inflation rate. If the GDP growth rate is very high, it tends to benefit almost all companies. If the GDP contracts, it can hurt most of the companies. So, market risk is the risk which emanates from economy-wide factors, and this risk cannot be eliminated however widely diversified the portfolio is. Empirically, it has been found that if you have a portfolio of 25 to 30 stocks, you can eliminate unique risk almost entirely, but you are exposed to market risk which cannot be eliminated or diversified away. This is a very useful graph to understand the relationship between diversification and risk. Here is a more colorful graph. Portfolio risk cannot fall below systematic risk, which is also referred to as market risk, irrespective of how diversified the portfolio is. To sum up, the total risk of a security is equal to unique risk plus market risk. Unique risk of a security represents that portion of its total risk which stems from company-specific factors. Unique risk is also referred to as unsystematic risk. Market risk of a security represents that portion of its risk which is attributable to economy-wide factors. Market risk is also referred to as systematic risk. A diversified portfolio eliminates unique risk to a large extent. However diversified a portfolio may be, market risk cannot be eliminated. How is the market risk of a security measured? The market risk is measured in terms of beta. Beta reflects the slope of a linear regression relationship between the return on the security and the return on the market portfolio. Here is a scatter diagram which shows the relationship between return on the market portfolio and return on a given security. Market risk reflects the slope of a linear relationship that best fits this scatter diagram. The slope of the straight line is fitted in such a way that the sum of the squares of deviations of individual points from the straight line is minimized. The least squares method is used to determine the slope. According to this method, the slope of the straight line is fitted in such a manner that the sum of the squares of deviations of individual values from the straight line is minimized. For calculating the beta of a security, the following market model is employed. RJT is equal to alpha j plus beta j RMT plus EJ, where RJT is return of security j in period T, alpha j is intercept term alpha, beta j is regression coefficient beta, RMT is return on market portfolio in period T, EJ is random error term. Beta reflects the slope of the above regression relationship. It is equal to covariance between the return on Rj and Rm divided by variance of Rm. Covariance between Rj and Rm is coefficient of correlation between J and M and the product of standard deviations of Rj and Rm. This simplifies to coefficient of correlation between returns on J and M multiplied by standard deviation of return on J divided by standard deviation of return on the market portfolio. The covariance term between the security J and return on market portfolio is equal to this. The calculation of beta may be illustrated with a numerical example. Here we have information on the return provided by security J for a period of 10 years. For year 1, the return was 10%, for year 2, return was 6%, so on and so forth. Here we have information on the return provided by the market portfolio over the same 10-year period. If we look at the return on security J over a 10-year period, the total adds to 120. So the average return is 12%. If we look at the return on the market portfolio, the total adds to 130. So the average return on the market portfolio is 13%. In this column, we look at the deviations of individual returns from the average return. So the first year return here is 10%, so it has a deviation of -2 from the average of 12, so on and so forth. Likewise, in this column, we have the deviations of the return on market portfolio from the average return on market portfolio. This column shows the product of these deviations. This column shows the square of the deviations noted in this column. If we look at the column which shows a product of deviations, the sum adds to 778. 778 divided by n minus 1, where n is the number of observations. So 778 is divided by 9 to get covariance between Rj and Rm. So covariance works out to 86.4. If we add all these numbers, we find that the sum is 1022. If that is divided by n minus 1, then we get the variance of return on the market portfolio. Beta is covariance between Rj and Rm divided by variance of return on market portfolio. Covariance is 86.4. Variance of return on market portfolio is 113.6. So beta works out to 0.76. Alpha is equal to Rj bar, that is mean return from security J, minus beta of J multiplied by Rm bar, that is mean return on the market portfolio. So alpha works out to 12 minus 0.76 multiplied by 13. It is 2.12%. What are the key determinants of beta? Beta is mainly influenced by the following characteristics of the firm: cyclicality of revenues, operating leverage, financial leverage. If the revenues of the firm are highly cyclical, other things being equal, the beta of the firm is likely to be higher. Operating leverage reflects fixed operating cost. If the operating leverage of a firm is high, other things being equal, its beta tends to be high. Financial leverage reflects fixed financing cost. If financial leverage of a firm is high, other things being equal, its beta tends to be high.
Here is the table which shows the beta values of Sensex stocks as on January 2023. From this table, we find that the beta values vary very widely. Beta values are fairly lower for stocks or companies which have virtually zero debt on their balance sheet and whose operating revenues are fairly predictable. FMCG stocks like ITC, Hindustan Unilever, Britannia, Nestle India, etc. fall under this category. Adani Enterprises, Adani Ports, Tata Motors, IndusInd Bank are few examples of stocks with high beta values. These are highly leveraged organizations with a lot of volatility in their earnings.
Here are average beta values for various industries in the US. Food and staples retailing 0.6, consumer staples 0.8, consumer services 0.9, insurance 0.9, consumer discretionary 1, media 1, financials 1, software services 1, consumer durables and apparel 1.1, diversified financials 1.2, energy 1.4. Let us recapitulate the story so far. Securities are risky because their returns are variable. The most commonly used measure of risk or variability in finance is standard deviation. The risk of a security can be split into two parts, unique risk and market risk. Unique risk stems from company-specific factors, whereas market risk emanates from economy-wide factors. Portfolio diversification washes away unique risk but not market risk. Hence, the risk of a fully diversified portfolio is represented by its market risk. The contribution of a security to the risk of a fully diversified portfolio is measured by its beta, which reflects its sensitivity to the general market movements. We now come to one of the most important models in finance called the capital asset pricing model. According to the capital asset pricing model, the expected return on a security is defined by this equation. Expected return on security I is equal to risk-free rate of return plus beta of security I multiplied by market risk premium, which is defined as the expected return on the market portfolio less the risk-free rate of return. A numerical example will illustrate this formula. Let us assume that the risk-free rate of return is 7%, the beta of security I is 1.2, the expected return on the market portfolio is 12%, and the risk-free rate is 7%. So the market risk premium is 5%, beta is 1.2, and risk-free rate of return is 7%. Given these values, the expected return on security I would be 13%. Remember, security I has a beta of 1.2, which is higher than 1. The market beta by definition is 1. If the market beta is 1 and market expected rate of return is 12%, a security which has a beta of 1.2 should have a higher expected rate of return, and that is what we find in this case. This looks like a very simple model, but it's a very powerful and elegant model. The developer of this model, Dr. William Sharpe, got Nobel Prize in Economics in 1990 for proposing this model. I had the honor and privilege of interviewing him in 1991 at Stanford University. I requested him to explain the thought process that went behind the development of this model. He explained for almost an hour how he developed his thinking on this issue and finally proposed this model. He put down this on a board in his office. He said, "I wonder why they gave me a Nobel Prize for a disarmingly simple idea." I paused for a while and then I said, "Sir, for the first time in the history of mankind, someone has derived a quantitative relationship between risk and return. From times immemorial, people always realized that risk and return went hand in hand, but there was no quantitative relationship well defined. This is the first time that someone has quantitatively defined what the risk of a security is. The risk of a security according to this model is beta and the relationship between risk and expected return. Here is another example. The beta of a security is 1.2. The expected return on the market portfolio is 15%. The risk-free rate is 7%. So the expected rate of return on the security is 7 plus 1.2 multiplied by 15 minus 7. This works out to 16.6%. Here is a graph which shows the relationship between beta and expected rate of return. In constructing this graph, I have assumed that the risk-free return is 10% and the market risk premium is 5%, which means the market portfolio would earn an expected return of 15%. Here is a defensive security which has a beta of 0.5, so the expected return on this defensive security would be 10% plus 0.5 times 5%, so it works out to 12.5% as shown here. Here is a security which is aggressive. An aggressive security has a high beta. This security has a beta of 1.5. The expected return on this security would be 10% plus 1.5 times 5%, which is 7.5%. So the sum adds to 17.5% as shown here. As far as the market portfolio is concerned, it has by definition a beta of 1. So the expected return on the market portfolio would be 10% plus 1 times 5%, which is 15% as shown in this graph. Despite serious limitations and flaws, the capital asset pricing model is perhaps the most popular model in finance for estimating the required return. There seem to be several reasons for its popularity. One, beta can be estimated with short data. If we have information on return on a security for a 5-year period, then we have 60 monthly return observations. 60 observations are considered fairly adequate for estimating beta. 2. Risk-free rate can be established. The risk-free rate of return is measured as the return on a treasury bill which has a maturity of 1 year or the return on a 10-year government security. These are easily known. 3. The market risk premium can be computed. Given historical information on risk-free rate and market return, the market risk premium can be estimated. 4. It is theoretically elegant. As we have seen, the capital asset pricing model is a very elegant model. 5. The distinction between unique risk and systematic risk is intuitively appealing. Almost everyone recognizes that unique risk can be washed away, so it need not be compensated for, whereas market risk cannot be washed away, so it needs to be compensated for. 6. There is lesser room for judgment. Despite its popularity, CAPM has serious limitations. It is predicated on several assumptions which don't always hold. It assumes that the market is perfect, which means that there are no transaction costs and there is no informational asymmetry. In the real world, there are transaction costs and there is informational asymmetry. It assumes that investors can borrow or lend at risk-free rates. This is often not possible in the real world. It assumes that investors are rational. Investors often display irrationality. Most concerning, realized returns often don't line up with betas. While CAPM has been hotly debated, it remains the cornerstone of modern finance and is used extensively for measuring cost of equity. Further, it has dominated the framework of investment management world. What are the implications for discussion so far? 1. Diversification is important. Owning a portfolio dominated by a small number of stocks is often a risky proposition. 2. While diversification is desirable, an excess of it is not. There's hardly any gain in extending diversification beyond 15 to 20 stocks. 3. The performance of well-diversified portfolio more or less mirrors the performance of the market as a whole. 4. In a well-ordered market, investors are compensated primarily for bearing market risk, but not unique risk. To earn a higher expected rate of return, one has to bear a higher degree of market risk. Let us sum up our discussion on risk and return. Variance, a measure of dispersion or its square root. The standard deviation is a commonly used measure in finance to reflect risk. The variance is defined as the average square deviation of each possible return from its expected value. Diversification reduces risk, but at a diminishing rate. According to the modern portfolio theory, total risk of a security is a sum of unique risk and market risk. The unique risk of a security is a portion of its total risk which stems from firm-specific factors. The market risk of a security is the portion of its total risk which is attributable to economy-wide factors. The variance of the return on a two-security portfolio is sigma p square equal to W1 square sigma 1 square plus W2 square sigma 2 square plus 2 W1 W2 rho 1 to sigma 1 sigma 2, where W1 is the weight attached to security 1, sigma 1 is the standard deviation, the return on security 1, W2 is the weight attached to security 2, sigma 2 is the standard deviation, the rate of return on security 2, rho 1 2 is the coefficient of correlation between the returns on securities 1 and 2. Portfolio diversification washes away unique risk but not market risk, and the risk of a fully diversified portfolio is its market risk. The contribution of a security to the risk of a fully diversified portfolio is measured by its beta, which reflects its sensitivity to the general market movements. According to the capital asset pricing model, risk and return are related as follows. Expected return is risk-free rate plus beta of the security multiplied by expected return on market portfolio minus risk-free rate. In a well-ordered market, investors are compensated primarily for bearing market risk but not unique risk. To earn a higher expected rate of return, one has to bear a higher degree of market risk.
To learn more about valuation, you can refer to the book Financial Management Theory and Practice, 11th edition by Dr. Prasanna Chandra.
Thank you.